Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to cash management. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 711 Cash Management tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We're going to go through that information up top. Then we'll have a smaller component of that information that we will use to work through the practice problems. Now, we're talking about cash management here. Now, note when we're doing kind of analysis into the future and doing projections and whatnot, the first thing we think about is what our sales will be. We'll think about the sales that we're going to be taking place. Next, we also want to think about the cash management with regards to how well we manage our cash. So that often takes like a back burner because sales is going to be the first thing that we want to consider. We want to increase the sales amount, and then we want to be considering the cash management so we can increase our cash flow. And if we can increase our cash flow, then we're typically in a better situation with regards to financing and being able to increase and whatnot. So what that generally means then on the cash management side of things is any kind of inflow that we're getting in cash, we want to get it sooner. So we would like to be able, for example, to be collecting on our receivables sooner. So any kind of inflow in cash, our goal is to get it sooner. Now, these differences could seem like they're not that significant, but especially if you're talking about a larger company, they can be quite significant because of the number of transactions that are in place and just the time management of money. So getting the cash sooner and holding on to the cash longer can make a big difference, especially as the company scales, gets larger in size, then it becomes material to really spend some time on this. So any receivable that we have, we're going to try to think about, okay, I want to get that faster. I want to get paid faster. How can we get paid faster? And then on the disbursement side, we would like to actually pay it later. Anything we could do to pay later, if we can make the processing of the checks even take a little bit longer. If we have a lot of checks that are going out, if we can hold on to the cash a little bit longer, then again, because of the time value of money, we will typically be better off. And it may seem insignificant when we think about it at one thing at a time, one transaction at a time. But when you're looking at a large company with many transactions, then it becomes significant to hold on to the disbursements longer. So if we can increase the time period in which something is due, if we're paying our vendors and they want to be paid within 30 days and we can allow ourselves to pay them within 60 days as opposed to 30 days, that would increase our cash management process. If we can do things like making the checks take a little bit longer to clear or something like that, then even that a little bit of time could increase the cash management. So that's going to be our goal. And if we could do that, if we can collect sooner, and we can hold on to the money longer on the disbursement side of things, then we're going to better our cash flow. We're going to have a more significant cash flow. If we have a better cash flow, then we're going to be more liquid, more able to cover our debts, and we may be able to use that cash flow in order to of course, get a return on it. So let's say this is our starting point. We have the cash collections per day at the 4,300, the cash disbursements per day at the 3,300. So the difference between the two being our net cash inflow. Then we have the collection time reduced. So we're going to say we're going to put in some practices that will reduce our collection times on the receivables in days, 2.6 days. So if we can basically collect on the receivables more efficiently, sooner, and increase the collection time by the 2.6 days, and then on the disbursement time, we're going to increase the number of days 1.4. So if we could do something to basically increase the amount of times per day, 1.4 days on the disbursements, the checks that are going out, possibly even slowing the process of the checks clearing the bank or something like that, to make it take have it take a little bit longer for the disbursement times 1.4. Then we were going to think about what kind of funds might be freed up if we were to do that. And then if we had those freed up funds and we wanted to do something with them, we want to put them in an investment, perhaps a savings account, or use them in some way to get a return on it. If we were to get a return of 7% on the freed up funds, then we could think about what kind of impact a policy such as this would do for those freed up funds. So here's a smaller component of our numbers up top, and let's go through the calculations. So we're going to say the additional collections. We're going to say that we're going to increase and be able to collect on our receivables 2.6 days sooner. So we're going to reduce the time that it takes for us to collect 2.6. And that's going to say the cash collections per day is at the 4,300. So if I multiply that 2.6 times the 4,300, let's just pull the trusty calculator out and do that. 2.6 times the 4,300, we're going to get the 11,180. So we're going to free up 11,180 just from that process, from being able to collect more quickly. And on the delayed disbursement side, on the cash payment side, we're going to hold on to the cash longer. So if we hold on to the cash longer, we're going to delay the number of days 1.4 times the cash disbursements per day of the 3,300. So if we multiply that out, the 1.4 times the 3,300, we get the 4,620. So we're going to free up another 4,620 by holding on to the cash a little bit longer. So if we think about the net then of those two items, and we were able to invest and get a return on that freed up cash flow, which is going to be the 11,180 plus the 4,620 for the 15,800. And if we were able to get a 7% return on that money, then we would have another interest or return of 1,106. So you can see if we could free up the cash, then hopefully we can use that cash in some way to get a return on our investment. So let's just do that again with a new set of data down here. Same kind of problem, new data. We're going to say the cash collections per day now are the 2,700. The cash disbursements are starting out at the 1,200. And then we're going to do something to collect a little bit quicker. So the collection time reduced by days of 1.4. So we reduce 1.4 days on the collection time. And then on the disbursement time, we're going to increase the number of days that we're going to be holding on to the disbursement by 0.6 days on the disbursements. So once again, we'll have the extra funds, the freed up cash that will result from this, and we're going to have a 9% return on that. So we have the additional collections then. We have the reduction in days, 1.4 times the collections per day, 2,700. Multiplying that out, that gives us 3,780 that we could free up in terms of cash flow. And then on the delayed disbursement side, we've got the 0.6 days that it's going to take us a little bit longer we're going to hold on to the money a little bit longer, times the 1,200 on the cash disbursements per day. That would free up $720. Then if we were to add up the freed up cash, that being the 720 and the 3,780, and multiply that times the rate of 9%. In other words, put that somewhere like a savings account at the very minimum, or someplace that we can get a return on the investment. Then we're going to get a 405 return on the investment. So again, on the cash management side, the general idea here, of course, being that we want to be able to collect any receivables sooner, and we would like to, if possible, delay any payments longer. And if we could do that, that will free up our cash flow. If we could free up our cash flow, we'll be more liquid, more able to meet our debts, and we have more possibility to take that freed up cash flow and put it in some place that will earn us a return on it.